We decided today to lower the target for the federal funds rate by 1/4 percentage point to a range of 2% to 2.25%. The outlook for the U.S. economy remains favorable, and this action is designed to support that outlook. It is intended to ensure against downside risks from weak global growth and trade policy uncertainty, to help offset the effects these factors are currently having on the economy, and to promote a faster return of inflation to our symmetric 2% objective. All of these objectives will support achievement of our overarching goal to sustain the expansion with a strong job market and inflation close to our objective for the benefit of the American people. We continue to expect that inflation will return over time to 2%. But domestic inflation pressures remain muted, and global disinflationary pressures persist. Wages are rising, but not at a pace that would put much upward pressure on inflation. We're mindful that inflation's return to 2% may be further delayed, and that continued below-target inflation could lead to a worrisome and difficult-to-reverse downward slide in longer-term expectations. Let me be clear. What I said was it's not the beginning of a long series of rate cuts. I didn't say it's just one or anything like that. What I said is when you think about rate cutting cycles, they go on for a long time, and the committee's not seeing that, not seeing us in that place. You would do that if you saw real economic weakness and you thought that the federal funds rate needed to be cut a lot. That's not what we're seeing. That's not what we're seeing. What we're seeing is that it's appropriate to adjust policy to a somewhat more accommodative stance over time, and that's how we're looking at it. What I said was it's not a long cutting cycle. In other words, referring to what we do when there's a recession or a very severe downturn. That's really what I was ruling out.